Joining us for the first market wrap-up of the year is Mark Wenzel from the Hopkins Group. Welcome, Mark, and Happy New Year. Welcome back to 2023.
Thanks, Michael. Great to be back, and wish all of the viewers a happy and safe 2023.
Right. Now, it looks like the markets are set for another interesting year. And having said that, how have the markets behaved this week?
Yeah, so a very interesting year as always. There's always plenty going on in the markets. I mean, we've sort of been talking a fair bit about inflation and consumer spending and all of those sort of things. We've had two companies report, Supercheap Auto and JB Hi-Fi have reported their 6 monthly sales figures to the market this week, with both reporting strong sales right through to the end of the year. Supercheap Auto, which owns its namesake Supercheap Auto, as well as Rebel Sport, BCF, which is boating, camping, fishing, and Macpac, reported strong sales growth on the year on all brands except BCF, which was down 2% for the year. BCF result is not surprising given the expenditure on outdoor and camping gear coming out of COVID last year. So it was a really solid result. But the sales report from Supercheap Auto is really strong and reporting that that the consumer spending is really strong, and so consumers, despite the rise in interest rates, are still reporting or still spending their money and opening their wallets. JB Hi-Fi continues to be a wonderful growth company with comparable sales up 4.9% on the year. This was a pleasing thing for investors because the JB Hi-Fi was able to pass on price increases, but also increase their profit margins. This will see an increase in profit when the group reports in February. Online sales, interestingly, represented 14.2% of sales, which was an increase of 10% for last year. But most consumers sort of reporting that they preferred click and collect rather than solely online. The sales in December and November drove demand, which indicated perhaps that the consumer is becoming more price sensitive, with Black Friday sales and also Boxing Day sales under that part. As we've talked about, we're at an interesting point in markets and the economy. Forecasts have been for consumers to cut back spending as interest rates have increased. Market commentators and analysts continue to forecast a slowdown in consumer spending this year, but all evidence so far in the actual numbers that are being reporting is showing no signs of distress and no signs of consumers slowing up their spending. It's robust. There's jobs are plentiful, and interest rates are starting to look like they're peaking. There's a clear divide in the economy, with middle-income earners spending the vast savings that they have, while lower-income earners are battling with higher interest costs and inflation. So it's going to be something that we're going to continue to monitor throughout the year.
The Reserve Bank, how are we looking in February, do you think?
Yeah, it's an interesting one, February. My view is that they're going to pause and just to see what comes through with regards to the raises that they've already had. But again, obviously, as we've talked about, I mean, the sales have been strong. So the consumer spending's been strong, and jobs growth has still been really strong as well. So it's probably a little bit of a 50-50 whether they go 25 basis points or pause here. But my view is that they'll pause and perhaps pause in March as well, and just see how the rate rises come through. And also, as we've talked about before, we've got another sort of 20% of fixed rate mortgages coming off in the next couple of months as well. So they'll move from fixed rates to variable rates, which will certainly have an impact on their ability to spend.
And Virgin Australia looking to return to being a publicly listed company?
Yeah, so again, another one we sort of talked about, sort of private equity sales. We talked about just before Christmas, and Virgin is currently owned by investment manager Bain, and they are looking to start the sales pitch for Virgin, which will occur in the second half of the year. The float is expected to go very well, with the timing exemplary by Bain, but should highlight cautions for those who are considering buying. As we know, airfares are at record highs. with increased demand and limited supply of seats, which creates ideal conditions for airlines to make super profits. Australia's got a duopoly airline system, with Qantas obviously being the dominant player and Virgin being the second player, but that makes it very attractive for potentially another airline, and it could attract new entrants to the market. There has been a new smaller player that's been granted a license recently, and you can expect foreign airlines to look at the bonanza and the money that's available in the Australian market, and potentially increase services which could sort of add more competition to the market. It would be hard to see better conditions for Bain to be selling Virgin into the market, and certainly potentially a terrible time for buyers to be purchasing the airline. Airlines traditionally have been really terrible investments, obviously very capital intensive, very labour intensive, and typically very difficult to make profits. The best example of that perhaps is Virgin, that was delisted 3 years ago with $7 billion in debt, and the share price tanked significantly from its original price. So with the float expected to be in the second half of 2023, you can expect really strong marketing about how profitable the business is and how well it's going. But certainly from my point of view, it's a cautionary tale for purchasers or potential buyers of the float.
And BHP keeping its focus on copper?
Yeah, again, something we talked about a bit at the end of last year as well, and just sort of the outlook on copper. With the electrification theme, most people are sort of trying to play the lithium stories, but certainly copper's potentially a really big long-term investment that could is really going to benefit from the electrification theme. And BHP reiterating its focus on copper as a commodity. They're spending sort of $4.8 billion to upgrade mines, and the reason that they highlighted amongst the presentations were that for the big investment into copper, that the grades of the existing mines are deteriorating, which will likely see higher copper prices, just because costs are obviously higher because they've got to mine more to extract a greater amount of ore. The second that they highlight is the access to water, which is essential to mining copper, is becoming harder to access in most of the mines that are available in any potential new mines. And there's also been the third point they highlight was a lack of exploration success, again, which will result in higher prices due to the limited supply and the demand increase, as we've talked about, for the electrification and higher standards of living from growing Asian consumers. So again, the copper story, is something that certainly investors should consider looking at. And you can obviously get the exposure through BHP. It sort of represents about 17% of BHP's earnings, but there's also other direct players for copper for those who are long-term investors.
Great. All right, Mark, we'll leave it there, and we'll chime in again next week with the next weekly report. Then that's why it's weekly. Thanks for your time, Mark.
Thanks, Michael. Thank you.